Hello guys, welcome back to another video. This is your financial management tutor, Sir Uzair Awan, and in today's video, we'll be covering another past paper question of the chapter Investment Appraisal. And the name of the question is Melplash Company. And this question is of March-June 2020 and is also present in your Kaplan kit. All right. So meanwhile, I'll teach you guys how to solve this question. I want you to open the question in front of you. If you guys have the kit, you can just open the question in the kit and keep that in front of you and then watch this video. All right. And the reason that I've selected this question particularly for this video is that if you guys look at part number A requirement, you can see that it says for the proposed investment in the new motorcycle, calculate the following. You have to calculate the net present value, you have to calculate the IRR, you have to calculate the payback period, and last but not the least, you have to calculate the return on capital employed. So there are quite different list of requirements that we have to, calculate in this question. So it's a very good question to learn how to do that, right? So let's start with the question. Let's first of all read the question and then see how we are going to solve it. All right. So the question says that Melplash company manufactures motorcycle and is considering an investment in a new high performance model. The market for high performance motorcycle is very competitive, and Melplash company directors want to recover the cost of investment in the model quickly before it is made obsolete by more advanced model at the end of 4 years. All right. The directors also wish to show shareholders that the investment will be profitable. The directors have therefore set a target payback period of 2 years. So you can see that the directors have set a target payback period of 2 years. So that means that in part number three, actually, when you're going to calculate the payback period, in part number three, when you're going to calculate the payback period, you will see whether it is equivalent to 2 year or less than 2 year or greater than 2 year, right? So depending on whatever payback period you get in part number three, you're going to make the decision whether this investment is acceptable to you or not. Because if the payback period that you get in part number three through your calculation is less than 2 years or equivalent to 2 year, then it's going to be acceptable, right? But if it's more than 2 year, then obviously it's not going to be acceptable for you. Why? Because the question says that the directors have therefore set a target payback period of 2 years. So it should be either 2 year or less than that. The directors will be happy to accept it, right? But if it's more than 2 year, then obviously they are not going to accept it, right? So that's something you guys need to remember while you are calculating the payback period. All right. Now it says a target return on capital employed of 20% for the investment. So again, there is a target of 20% for your return on capital employed, which means that if your return on capital employed is going to be 20% or more, only then the directors would consider this project, investing in this project. Otherwise, they won't, right? So, again, that's something you guys need to keep in mind. And then they're saying the directors have also asked the finance director to provide DNPV and internal rate of return calculation for the investment. They plan to consider the result of this calculation if the investment fulfills the target for payback and return on capital employed. All right. And after that, you guys have the normal data that you guys need to calculate the NPV, right? So you can see we have the years, we have the forecasted, amount of production and sales given for the motorcycle for each year. And then we have been given the initial investment, the residual value, and all these stuff. Now, one thing that I want you guys to focus on before we start solving the question is that do you see after selling price, after variable cost, and after the incremental fixed cost, they have written something inside the bracket, and that something says that year one price term, right? Year one price term, year one price term. So, what does this year one price term mean? Now, if you guys see, that for selling price, for variable cost, and for incremental fixed cost, they have given us the inflation for each one of them. For selling price, the inflation is 6% per year. The variable cost is 6% per year. And the incremental fixed cost inflation is also 10% per year. So that means that we will have to adjust these values with the inflation, right? So these are current values and we have to adjust them into nominal values by adjusting for the inflation. Okay. So if it says 20,000 per motorcycle year one price term, it means that in year one, you're just going to enter 20,000 as the selling price of the motorcycle. And from year number two, you're going to adjust it by 6% per year to adjust for the inflation. All right. Similarly, if you look at variable cost, that's the same thing for variable cost. For year one, you're just going to take this 14,000 as your year one value. And then from second year, you're going to adjust at 6%. And same goes for your incremental fixed cost. All right. So this is something that you guys need to remember. If it says in the bracket year one price term, you just, take the same value for year one, and from year two, you adjust for inflation, right? Whereas in normal questions where this is not written, we start adjusting from year one and onwards, right? But in this particular question, we will just take year one values as they are, and from year two, we will adjust it. And the reason is because they have written the bracket year one price term. Okay. So that is something you guys need to keep an eye on. And now let's start with the questions. So we have our year zero, year one, year two, year three, and year four. All right. And as you guys know that I will start with my investment. Okay. And investment is always written on year zero. So how much is the investment? It's 220 million. All right. After that, the second thing that I take is my residual value, and it always goes at the end of the year, which is year four. So let's see if we have the residual value in the question. Yes, residual value at the end of year four is 30 million. So I'm going to write 30 million at year four. And then after that, I always write my contribution, which I have told you guys that I do the calculation for this, right? So contribution needs to be calculated because you guys know that contribution is basically selling price minus the variable cost. I'm just going to give the reference of working. And now I'm going to start with my selling price first. All right. And let me just write my years. Okay. So selling price, how much is it for year one? Now you can see, like I said, for year one, you're just going to take the same value, which is 20,000. All right. And now from year two, you're going to adjust it for inflation. And how do you adjust it for inflation? Just take the previous year selling price and times it by 106%, because right now it's 100% and it's going to increase by 6%. So that's 106%. All right. So our year two selling price is going to be 21,200. Okay. Similarly, for year number three, just select year two and times it by 106%. You will have your year three selling price. And then for year four, select year three and times it by 106%. You will have your year four selling price as well. All right. Now, from these, we will have to subtract our variable costs to get the contribution, right? And for variable cost, obviously, we have to do the same thing. You can see variable cost year one price term is 14,000. So that means for year one, it's going to be the same one as given to you in the question, 14,000. No inflation adjustment needed. All right. And now from year two, I'm going to adjust it for inflation. So I'm going to select year one variable cost. I'm going to times it by 106%. Why 106% again? Because you can see that even variable cost inflation is 6%, similar to that of selling price, right? So they both have the same inflation rate. So I'm going to times it by 106%. I have my year two variable cost and then select year two times it by 106%. That's going to give me my year three variable cost. And then I'm going to select year three variable cost and times it by 106%. And that's how I'm going to get my year four variable cost. And now I will obviously need to subtract them to get my contribution, which I need, right? All right. So I have the selling price, I have the variable costs, right? I have the selling price, I have the variable cost. And now what I need to do is to take the selling price and subtract variable cost from it so that I can get my contribution, and I can just press Control C and then select the other three cells and press Control V. In that way, it will just copy paste the same formula for all of them. So you can see I got my contribution for all the 4 years. Right now, I'm going to multiply this contribution with number of units, right? So for year one, we had how many units? We had 25,000 units. For year two, I will have 45,000 units. As per the question, you can see number of units are given over here, right? For year three, I have 40,000, and for year four, I have 20,000. Okay. And obviously now I'm just going to multiply the contribution with the units. Okay, so I have my year one contribution, as you guys can see. All right. And I'm just going to press Control C, select the other three remaining cells and press Control V. And I just need to increase the size of the cells so that they can give me the complete value. And you can see that I have my year 1, year 2, year 3, and year 4 contribution. Okay, just what I needed. And now I'm going to put that into my solution. Now, while I try to paste the contribution in my working, just remember that the investment and the residual value that we have taken were in millions, right? So we have just written, 220 and 30, which means that we have ignored 6 zeros, right? So that is exactly what you need to do over here for contribution as well. Either remove 6 zeros and write the remaining value as your contribution, or you can convert this 220 and 30 into millions, right? So that you can, just paste this contribution as it is, right? But I would not prefer that because that's going to give you a very, big values to deal with, right? So it's better that you keep your value small. So what we're going to do, we are just going to take, we're just going to remove 6 zeros from over here. So for year 1, it's going to be 150, 150. For year 2, it's going to be 286.2. For year number 3, it's going to be 269.6, right? And for year 4, it's going to be 142.9, correct? Okay, so with that, we have our contribution, we have our residual value, we have our investment. Now, what I do is that I write the fixed cost after that. All right. So, how do I write the fixed cost? You guys can see that for fixed cost, they're saying that over here, incremental fixed cost year 1 price from 120 million. So that means that for year 1, it's going to be same 120. And from year 2, you're going to increase it by how much? By 10% every year. So just select 120 times it by 110% because it's increasing by 10%, right? And you have to do the same for your year 3 as well. So it's the same way, just like we have learned in our classes, right? 110%. All right. So you can see that I increased by 10% each year. So now I have 120, 132, 145.2, and 159.7. All right. Now, before moving forward, I just need to make sure that I put negative signs with the outflows, right? So you guys know that investment is the outflow for the company because the cash is going out of the company when you make an investment. So you're going to place a negative sign. Residual value is an inflow, right? So it's going to remain positive. Contribution is also an inflow, so it's going to remain positive, whereas fixed cost is your cost, right? So it's an outflow, so remember to place the negative signs with it. And just like you see, I adjusted the negative sign in cell number 1 and all the other cells adjusted for itself by, because we have, connected all these cells with the first one, then the third one is connected with the second one, then the fourth one is connected with third one. So with that, it just, adjusts automatically because each cell is connected with the previous one. All right. So now you can see that our fixed costs are also negative. Okay, now after fixed costs, I usually calculate my tax payment, and then after tax payment, I calculate my tax saving. But since this question has already told us that we need to ignore taxation, so that means there is going to be no tax payment, there is going to be no tax saving, right? So we're going to ignore all that. Let's see if there is anything left. And no, everything is accounted for. Okay, so now we are going to calculate our net cash flows, and net cash flows can be, calculated by taking the sum of all the cells, right? So I'm just going to press Control C, select all the remaining cells, and press Control V. In that way, I have my net cash flows, and we multiply them with their respective discount factors, which we will have to calculate. So there's a formula to calculate discount factor, which is 1 over 1 plus I to the power of n, right? So let me just place the bracket 1 plus I. I is the discount rate which was given to us in the question over here. And since it is nominal, we do not need to adjust it for inflation because it has already been adjusted. It's nominal, right? So it's 14%. So my I or my discount rate is 14%. Okay. And the power is going to be 0 because it's year 0, right? So here I have the discount rate for year 0. Now I'm going to Control C and Control V for all the other years. And now what I have to do, I have to just change the power one by one for all the years, right? So 1, 2, then 3, and then 4. Okay. And now I will calculate my discounted cash flows. Okay. So for that, all I have to do is to just multiply the net cash flows with their discount factors. I'm just going to multiply the first one and then I'm going to press Control C, select all the remaining cells and Control V, and in that way I will have my discounted cash flow for all the remaining cells, right? Okay, now we just need to do a little bit of formatting, right? So, all right, there you go. Let's do full screen again. All right. Now we have our discounted cash flow, and in order to calculate NPV finally, which was our first requirement, I'm going to apply the sum function and select all my discounted cash flow from year 0 to year 4 and close the bracket. So you can see my NPV came out to be 16.7. My NPV came out to be 16.7. All right. So this is my NPV, guys, 16.7. All right. So here is the solution to part number 1, where we have successfully calculated our NPV. All right. Now, part number 2, let's read what it says. It says that we have to calculate the internal rate of return. Now, internal rate of return can be calculated using the interpolation method, but I, prefer using this function of IR, right? So this function is very easy and it's actually applicable where you have, you know, year by year in time order, right? So we do have year by year in time order. So we can just apply this IR function and you're going to, select your net cash flow. Remember that IRR is not applied on discounted cash flow. It's always applied on net cash flow. So you're going to apply the function of IR and you're going to just select your cell from year 0 to year 4. You're going to select all the net cash flows, all right? And then close bracket, and there you go. 18% is your IRR. And with that, the second requirement is also fulfilled. Okay, so as you guys can see, the first requirement and the second requirement is done. We have the NPV, we have the IRR. I hope it's clear to all of you guys. Now let's move to part number 3. Part number 3 says you have to calculate the payback period, right? Now remember, this is not discounted payback period. It's a normal payback period, which means that we are going to use our net cash flows, not the discounted cash flow, right? Now, in order to calculate the payback period, I will just try to copy the net cash flows as they were, right? So we have 220, we have 30, right? We have 154.2, we have 124.4, and we have 13.18. Okay, so I just, copied my net cash flow, and now I'm going to make a row of cumulative cash flow because that is what we need in order to calculate the payback period, right? And if you guys now remember from our classes that how do you get your cumulative cash flow? The first one is just the copy paste, right? The second one you can get by adding minus 220 with 30, okay? Then minus 190 with 154.2, then minus 35.8 with 124.4. Let me just remove these. I mean, not remove it, just move it a little bit over here so that we can have space to calculate our payback period. All right. So, okay, now we have our net cash flows, we have our cumulative cash flows. So now I have to calculate the payback period, right? And you guys know that payback period is you basically see the year before which your value become positive. So you can see my value become positive at year 3. So I'm going to look at the year before that, which is year 2. So I'm going to say 2 years, right? And then we have to look at months, that how many months it is, right? So for that, I told you guys to always take the value which is the cumulative cash flow, which is before the year the cumulative cash flow become positive. So cumulative cash flow become positive at year 3. You're going to look at year 2 cumulative cash flow, which is 35.8. So write 35.8 and you're going to divide it by the net cash flow or year 3, net cash flow of year 3. Okay. So you can see it's 0.28, 0.28. So let's round it off and let's see what do we get. If I round 0.28, it's going to be 0.3, right? So you can see after rounding off, it's 0.29 or 0.3. years, right? Because 2 years plus 0.3 months, so that's going to be 2.3 years, right? 2 years plus 0.3 months that we have calculated, so it's going to be 2.3 years, and that's your payback period, all right? And with that, we have our answer to the third requirement of the question, which was to calculate the payback period. So the payback period is 2.3 years. The payback period is 2.3 years, all right? And now the last requirement in which we have to calculate our return on capital employed, right? Now for return on capital employed, you guys know that it can be calculated based on the initial investment and it can be calculated based on the average investment. And in part number 4, they have clearly specified that you have to calculate ROCE based on the average investment, right? So either it's average investment or it's the initial investment. We have to calculate one thing which is common in both of them, which is the project's PBIT, right? Okay, so the first thing that I'm going to calculate is going to be my average cash flows, all right? And for average cash flows, what you have to do, you have to select the net cash flows, add them together and divide it by number of years. So the number of years you can see are 4, right? 4 years. So I'm going to take the net cash flows of 4 years. I'm going to add them together and divide it by 4. And that's how I'm going to get my average cash flow, right? So let's do that. For year 1, you can see that our net cash flow was 30. For year 2, you can see that our net cash flow was 154.2. For year 3, you can see my net cash flow was 124.4. And for year 4, you guys should remember from my lecture, I told you that for the last year, you always take your net cash flow for the last year and then from that you subtract the residual value because residual value is always given to us for the last year, right? So 30 plus 154.2 plus 124.4 plus 13.18 minus the residual value which was 30 in the question, right? As you guys can see over here as well. And that's gonna give me my cash flows. Now, in order to average them, I will have to divide it by 4, right? These are total cash flow. I will have to divide it by 4, okay? So for that, let me just place another bracket and then divide by 4. So that's gonna give me 72.945 as my average cash flow. And from average cash flow, what do? We subtract the accumulated depreciation. So for that, there is a formula that we have been using for many years, which is that you take your investment 220, you subtract the residual value from it, which is 220, subtract the residual value 30 from it, and divide it by the number of years, which are 4. In that way, you will have your accumulated depreciation, which is 47.5. All right. And now finally, what we needed to calculate was our PBIT, which is profit before interest and tax average. And for that, you select your average cash flow, you subtract from it the accumulated depreciation. So you get 25.445 as your PBIT average, which can be rounded off to 25.45. All right. So after having our PBIT average, now we need to calculate our ROCE. So since this is based on the initial investment, first of all, we will have to calculate the initial investment as well. Okay. So average investment is going to be the investment, which is 220 plus the residual value, which is 30, and you always divide it by 2, like we have learned in the class, right? So you get 125 as our initial investment, right? And now I'm going to calculate my ROCE, return on capital employed. So for that, I'm going to select my PBIT average divided by the initial investment. Okay. Let me just quickly place the brackets over here because I have to times it by 100 because I need the percentage, right? So times it by 100. Okay. So again, PBIT average divided by the initial investment times it by 100. You get 20.36 as your ROCE. Okay. And 20.36 can be rounded off to 20.4. So 20.4% is your ROCE. Okay. And with that, you can see our requirement number 4 is also complete. We have successfully completed all the parts. Part 1 where we had to calculate the NPV, part number 2 where we had to calculate the IRR, part number 3 where we had to calculate the payback period, and part number 4 where we had to calculate the ROCE. Okay. So If, for example, the question would have told you to calculate the ROCE based on the initial investment, so you guys know that this part of the working would have remained exactly the same, and the only change would have been that instead of dividing your PBIT average with your average investment, you would have divided your PBIT average with the initial investment, right? But since in this case they have already asked us to calculate it all based on the average investment, so we have done exactly that. First of all, we have calculated the average investment, and then we divided our PBIT average with the average investment to get our ROCE. So here's a complete overview of the solution of this question, and with that, the objective of today's class has been met. If you guys like this video and found this helpful, just make sure to subscribe the channel, like this video, and if you guys have any question regarding anything, you can always comment in the comment section, or you can contact me directly. You can find my number in the description of this video, and I'll meet you guys in the next video. Till then, take care. Have a great day. Goodbye.